How share market works and shares price changes? The stock market, also known as the share market, is a platform where publicly traded companies' stocks are bought and sold. When you purchase a stock, you own a small portion of the company, and your ownership is represented by the stock certificate. The stock's price is determined by the supply and demand of that particular stock in the market. Supply and demand are the two most important factors that determine the price of a stock. The law of supply and demand states that the price of a stock will increase when the demand for it is higher than the supply, and it will decrease when the supply is higher than the demand. The supply of a stock is determined by the number of shares that are available for trading. This includes the number of shares that the company has issued and the number of shares that are held by investors. The demand for a stock is determined by a number of factors, including the financial performance of the company, the performance of the economy as a whole, and investor sentiment. If a company is performing well, it is more likely that people will want to buy its stock, which will drive up the price. On the other hand, if the company is not doing well or if there is negative news about the company, people may want to sell their stock, which will drive down the price. In addition to supply and demand, there are several other factors that can impact a stock's price. These include interest rates, inflation, and political events. For example, if interest rates are low, it can be more attractive for people to invest in stocks because the returns on bonds and other fixed income investments are lower. On the other hand, if interest rates are high, it can be less attractive for people to invest in stocks because the returns on bonds and other fixed income investments are higher. Let's look at an example of how the stock market works. Suppose you are interested in buying stock in a company called ABC Inc. ABC Inc. is a publicly traded company, which means that its stock can be bought and sold on the stock market. You go to your brokerage firm and place an order to buy 100 shares of ABC Inc. at the current market price of $50 per share. Your brokerage firm then matches your order with an offer from a seller. In this case, the seller may be an individual who already owns the stock, or it may be a market maker, who is a professional trader who buys and sells stocks on behalf of clients. Once the trade is complete, you own 100 shares of ABC Inc. stock, and the seller has received $5,000, 100 shares x $50 per share, for their shares. Now, let's say that ABC Inc. releases its earnings report, and the report shows that the company is doing well and is expected to continue to perform well in the future. This positive news leads to an increase in demand for ABC Inc. stock. As a result, the price of the stock increases to $55 per share. If you decide to sell your 100 shares of ABC Inc. stock at this new price, you would receive $5,500, 100 shares x $55 per share, which is a $500 profit on your original investment. However, it's also possible that the price of ABC Inc.'s stock could decrease. For example, suppose the company releases a negative earnings report or there is negative news about the company. This could lead to a decrease in demand for the stock and a decrease in the stock's price. In this scenario, if you decided to sell your 100 shares of ABC Inc. stock at the lower price, you would receive less money for your shares, and you would have a loss on your investment. Please like, subscribe and share our videos.